Hi, it's Lee and welcome to the Tesla Economist. Alright, as you probably noticed, Tesla is dropping again. We saw it touch about $220 one day, mid-Feb, but is since down over 20%. From that, now at around $170. Still nowhere near the bottom we saw earlier this year at around $100, but still moving away from more of a comfort zone for many investors, especially those who are holding from buying at around $300. And I understand how many of you are down millions of dollars since then, and it's not easy. And this recovery, or recent bull run, has made it somewhat tolerable. Well, this recent drop is again due to many factors. We had the sell-off after Investor Day, with investors not happy that no new model was announced. We have some issues with a few cars. We've had more price drops. We have Elon getting political again. But mainly, the market is at the mercy of the Fed still. Inflation is not going away. They've done what they can to reduce it. The low-hanging fruit where possible, like transitory side of it, but we're still facing true monetary inflation. Once money is printed, it's very difficult to unprint it. And the number one tool we have with monetary policy to combat inflation is indeed interest rates. So now the market is concerned that rates will actually rise, and higher than we expected. In January, the market was very brave and calling Jerome Powell's bluff, and we saw a massive bull run. The market was forward-looking, and even managed to see rate reductions as early as the end of this year as a possibility. So you just need to hold until then, and then the market will recover to possibly all-time highs. Inflation looked as if it was on its way down, and the interest rates were actually having an impact. But now the numbers are not looking like that may be the case so much. Of course, if Jerome Powell does raise rates as much as 50 basis points, he will look like even more of a moron than he does already, and lose even more credibility. They're trying to crush inflation without crashing the economy or markets, and aiming for this so-called soft landing, which looks very hard to pull off. Sometimes the market believes it's possible, other times it doesn't. Sentiment is incredibly fickle right now, and as a result, the VIX is up 17% today, to about its high for the year. So what does all this mean, specifically for Tesla? Although Tesla is not a car company per se, the vast majority of its profits do come from cars. As interest rates rise, then capital expenditures that are purchased with debt fall. This would include cars and real estate. So the aggregate demand for autos will drop. This would include Teslas. Tesla's reaction to this may be to drop prices further. Of course, they could always advertise, which seems to be an unpopular opinion, but there are still a lot of consumers out there that don't understand the benefits of electric cars, or Tesla specifically. But it seems that Tesla prefer to drop prices instead. Tesla are, however, reducing their costs simultaneously, and there has been some deflation for Tesla too, along with more automation and less labour required to assemble vehicles. People say that Tesla has started a price war, but we're not seeing Legacy really engaging in price drops, aside from a small drop with Ford's Mach-E. So every time Tesla drop their prices, if it's due to aggregate demand, they're increasing market share, even if Tesla are not increasing supply. However, Tesla are also increasing supply at the same time. It's more than likely Q1 will see record production and deliveries again, which means the aggregate demand for cars drops, but the supply of Teslas increases, which means Tesla's market share increases in two ways. We also hear that Tesla has the best customer retention over all other auto brands. So once Tesla get a customer, then they retain that customer better than any other manufacturers. And myself, after owning a Tesla, I really don't know how I'd want to go back to something else, just based on the sheer driving experience, let alone the technology and safety on top of that. So if rates continue to rise, and perhaps the economy actually does start to slow down more, then the auto industry will get hit. But as far as Tesla is concerned, this will mean a reduction in gross profit, rather than a reduction in actual unit sales. But within time, there will be a return to normality, where rates will drop, and the economy will recover, even if it's not for another 2 or 3 years. We know how popular Teslas are in those economic times, and that Tesla may return to more like a 25% gross margin. Yes, possibly 30% if 4680 sales ramp up and the costs get as low as Elon tells us, and if the Gen 3 car is highly profitable, and if tax credits and subsidies remain, etc. However, there's nothing wrong with 25% gross margin. And as I've been talking about at length for years, is gross margin isn't the important factor. It's all about operating margin. And Tesla have outstanding operating leverage. As Tesla continue to grow and sell more vehicles, the discrepancy between operating margin and gross margin reduces. For example, we've been at around 15% operating margin recently, yet up around 30% gross margin, but only around just over 1 million vehicles a year. As this approaches more like 3 million or more, then even if we are at 25% gross margin, operating margin will start to come up to closer to 20%. This is a big difference. What I'm saying is that even though Tesla may have reduced prices, the actual operating margin is not affected. Of course, that operating margin would be at a slightly lower ASP, but there's still good profit there. One of the aspects of this operating margin we've had in the past is that they've been brought down by the energy business. The energy business has been basically running at break even for the last few years, or even at a loss. This means the operating margin drops. But now we're finally seeing energy with higher margins and actually making some decent profits. This will also help bring up the operating margin, especially if we're going to see energy at 30 to 40% gross margin. And the same will be true for services and other. Not only that, Tesla has subsidies from the US government, which are just going to come in as pure profit. That also increases operating margin too. Anyway, when we bring all this back in and start to estimate what a forward PE for Tesla may look like, now the stock price is lower, it's starting to look good value short term. If it continues on this decline and drops to perhaps 140 again, which I don't think will be likely, but it could be possible if we see panic in the market, then at around that price, I would actually call Tesla close to a value stock. If we look at Coca-Cola right now, it has a P ratio of 27. Do you think Coke has much potential for growth compared to Tesla? Sure, Tesla has a P ratio of 47 right now, but I focus more on a forward PE for Tesla as it is a growth company, a realistic one that we can calculate with our projections as we likely know Tesla better. And if Tesla are able to generate $15 billion in earnings this year, then that is also a forward PE ratio of 27. Now, those earnings are based roughly on Tesla's current prices and around 1.8 million deliveries for the year. If they have to reduce prices somewhat, then earnings will be less. But my point is, those price reductions are due to the interest rates, which are likely temporary. So at the end of the year, if the stock price or vehicle prices didn't change, Tesla would be trading at a P ratio of 27, which appears to be a P ratio of some value stocks that show very little signs of growth over that time. Even this year alone, though, Tesla has many reasons to boost that P ratio. If they can show to the market that they can successfully make a Cybertruck, that will boost the stock. If they can show they can really ramp up 4680 sales, that will boost the stock. If they can show they have so much belief in future vehicles and demand that they start building a new factory and build it fast, that will boost the stock. If they show they believe they can make the semi-truck with 4680s and start extending Nevada, then that will also boost the stock. Yet we're floating around a P ratio of 27, perhaps at the end of this year, at their current trajectory. Sure, the stock market is potentially walking on eggshells right now and concerned about a real market crash and going into a proper recession, which is obviously a possibility still. And this may be something investors have to go through, and the auto industry is affected as it is cyclical. But due to Tesla's lack of debt, pricing power, and income from energy, it will simply be that much harder for the competition. Tesla's costs will reduce during such a time, and they can reduce prices and maintain profits. And hopefully the Cybertruck has so much demand that a recession won't affect that. And possibly as early as next year, there may be another vehicle that is recession resistant too, along with the semi-truck. And eventually the market will come out of any such rut, and people will start buying cars again. So yeah, Tesla is looking like it's a good price right now, but if it gets much lower, it's going to start looking like an actual value stock. And that's what happens in recessions. Growth stocks become value stocks. Then the market recovers, and eventually another bull run, and growth stocks go back to P ratios of around 100 or so. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.